This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Nitin Rai, managing partner of Elevate Capital. Elevate Capital is a diversity, equity, and inclusion-focused fund that invests in U.S.-based early-stage startups led by underrepresented entrepreneurs, including women, BIPOC, LGBTQ, and veterans. Nitin, thank you for joining us.
Thank you. Good to see you.
So where are you calling from today?
Today I'm in New York City.
Great. Well, tell us more about your background. What did you do before Elevate Capital?
So my background is immigrant from India, software engineer. Started my career in Silicon Valley, working in AI in 1987, and subsequently moved to Oregon, worked for a much larger company as a software engineer. And then in 1994, I quit my job and started a company called First Insight, which is my 30-year-old startup now. And we developed software, EHR software, management software for eye doctors. But that's what I did before Elevate.
Great. And so how has your entrepreneurial journey shaped your fund?
I am the most non-VC VC you'll ever meet. Entrepreneur first. So I bring the entrepreneur point of view. I raised a lot of venture capital, and in the middle of the dot-com bust, the company almost got killed by the VCs that invested in me and the company. And so I take an entrepreneur first approach. And we, bring a lot of value to me and my partners. Many of them are ex-entrepreneurs, in terms of having that lived experience of an entrepreneur to these founders that we're investing in.
Great. Well, tell us more about starting a VC fund. What's that like these days?
Today, I think it's rather hard with the macroeconomic climate. A lot of the institutional capital funds, fund of funds, have kind of pulled back, and it's really hard for emerging managers to raise money. I got lucky. I raised it, 2 years ago, my second fund. And we have deferred actually our third fund for that reason, because of what's going on in the stock market and how it's affected the cascading effect to VC funds as well as startups that are having a hard time raising money right now.
And so what's the opportunity with starting a VC fund? What can you do with it that you cannot do without a VC fund?
I think prior to being a VC, I was actively investing my own money as an angel. I have launched Thai Oregon Angels in Portland, which is basically a group of investors that are investing and mentoring. And I was quite successful doing that. But you run against you have limited pool of capital. It's difficult to do follow-on into those companies. And because you're angels, you really only own a very small piece. So you don't have much influence over the entrepreneurs once they've taken your money and they start taking money from other VCs. And I find that, our value add is substantial enough that we needed a larger pool of capital. I was not interested in becoming a VC. I got approached. And when somebody comes to you and say, hey, love your track record, love what you're doing, if you'd be interested in starting a fund, we'll invest in you. That's how I got me started. Otherwise, there's no way I would have gone out and raised money. It's hard.
Well, great. And so what's the challenge in starting a business in today's market? What do you find you struggle with the most?
I think two things. One, startups that have already raised money and have shown progress, many of them had targeted this year as the year to go raise their next round of funding. And a lot of that has dried out. There's not a lot of, VC money available. So they've delayed that. And so what they're doing is coming back to investors like me, that are existing investors, for bridge rounds. That's sort of the name of the game right now, is a lot of the companies are going back and raising bridge rounds because two things: A, less capital; B, stock market's down, 30-50%. So there's pressure on valuation. And some of them raise money at much higher valuations. It's what I call the bubble valuations. So now they're going to get down rounds. And, that's a hard apple to bite, to take a dilution.
Great. And so what is the potential reward for startups today? What kind of exits are we seeing out there?
I haven't, at least in my portfolio, seen any exits this year. We did have an exit last year, which was, kind of the beginning of the meltdown. And they had to sell for 50% of what they were originally offered. So I think there is an opportunity because a lot of these funds are looking to not just what I call private equity funds that do a lot of secondaries and they do majority buyouts. But also strategics are looking for deals that are value deals that could be great add-ons to their business. So of course they're out there, but the valuations are low. And so people are being very selective on who they want to buy.
Well, great. And how is your fund different from other diversity funds in the market?
We are different because we take a more, I would say, a smarter approach to liquidity. I won't say smarter, but just a different approach. We consider ourselves as a micro PE fund. Our thesis is around generational wealth creation, and we feel you can't create generational wealth in a lot of these companies that we're investing in if we have to wait 14 years for a liquidity event. So we invest in companies very intentionally that kind of fit the model where they can build, let's say, 5 million ARR in the next 3 to 5 years. And at that point, we socialize them with private equity funds, growth equity funds, or strategics that might be willing to do either a secondary or a full buyout where we can get our money out, maybe 3 to 5x in 3 to 5 years, and then also offer secondaries to these founders so they can get a first bite at the apple. And eventually, they might get a second or third bite at the apple. But our approach is we want to return capital back to our investors at a much faster rate because all that money then gets recycled and reinvested in future funds. So for instance, our first fund, which is a $10 million fund that we launched in 2016, we've already returned $12 million back to our investors. And what's the more important metric there that we look at is generational wealth creation. There's about $200 million of generational wealth created from 7 exits. 60 million has already been returned. Average return per founder, 12 million. And our hold period, 3 years, return 4x. So that's how we're different.
Well, great. And so you talked about being entrepreneurial friendly. How does Elevate Capital take a hands-on approach with the portfolio companies?
Sure. We come on board as either advisors and board members. We take a lot of board seats. Pretty much every other company, we have a board seat. Some of our LPs that are venture partners become advisors to these companies, and some of them actually join forces with them. They might join their C-level team. So we've done a number of these sort of things from that perspective. Then, we have a network of other investors. So when they're raising a round, and if we're leading in, we might bring in a syndicate. When they're doing bridge rounds, we might invite other people into it. So we become their spokesperson. Obviously, performance is important. So if you're performing, we're in supporting you. If you're not performing, then we're still there to help you if you want our help to get you out of any messes that you get into.
Great. Well, what are some of the most important factors in mentoring portfolio companies? Where are you spending most of your time?
I think we spend most of our time in strategy with the founder. And the second part is the fundraise. So those are the two most important things. And the founders that, we don't force ourselves on any of these companies. So, we like founders who are transparent, who lean in. And the ones that lean in, we get together as frequently as they need to on any kind of problems they're facing, whether it's resources, whether it's dealing with angel investors who might be difficult with them. But most importantly, on the go-to-market side and growth, we add a lot of value in terms of strategizing with them and helping them see through what the best paths are to grow the business.
And so what's one thing about your fund that happened that you didn't expect?
Well, I never expected that I could raise 40 million that I did raise in the middle of the pandemic. And
that's a pleasant surprise.
21 million of first close, and we thought we were dead for fund 2. I think that was completely unexpected. The fact that I got approached by Rukiah Adams, this lady, Rukiah Adams from Meyer Trust, she changed my life. Like the fact that somebody would grab my wrist and pull me aside and say, I want to talk about your next career move and then offer me money. And nobody has ever done that. That was totally unexpected. All other things you expect, you expect entrepreneurs, not everyone can make it. But, one thing that is very different about us is that more of our companies are surviving and thriving than less. So the very first cohort that I invested in, I was in a talk yesterday about this, surviving to thriving, especially in these times. The first 6 investments we made, only 2 died, 4 made it, 2 are surviving and thriving, 2 already provided liquidity in 2016. So I never expected it, but it happened because we're intentional about it.
That's great. Well, in the current market, what sectors do you think are safe havens for investors in the current landscape?
Well, a few. climate tech. I think climate tech has a huge potential. Anything with the government, anything essential, right? So healthcare, which is something that we invest in, some fintech, I think education has huge potential. And with finally the realization of AI, which I think ChatGPT is sort of the foundational technology now that is going to drive a lot of new ideas and new companies that are going to be built on that platform. I think that's an area to invest in, whether you have an existing product or you have new ideas. I mean, yesterday I saw a pitch of a number of really great companies and 22-year-olds with great ideas using AI. I think that's the future. And I dreamt of that when I was a startup engineer working for an AI company. And some of those ideas are now coming to fruition. So I think there's huge opportunity there during this time.
Well, great. And so what advice do you give to someone founding a company in today's market?
Be nimble, be really nimble, and be humble. If you've got an idea, your skin in the game is just do the work. Like, don't come up with some idea and go to the bro club and think you're going to get funded. That's not going to happen anymore. So, have an idea that's well synthesized, bring in some mentors and advisors who can give you guidance on how to take the next steps, because money is scarce, but money is there. And I think this is the time when angel investors really shine. And so go find some good angels or get connected into an angel network. Like, I'm part of Thai Oregon, Thai Global. Some of us funded some really great companies in Oregon during the crisis. And I was just reading up an article on Airbnb. Airbnb raised money in 2008 in the middle of by getting accepted to YC. Just go in that direction and don't think with your idea, you're going to raise $10 million for a $50 million pre-money valuation with a piece of paper. That's not going to happen.
Well, great. Well, you see a lot of new technologies and business models. If you could start a business tomorrow in this space, what would that business be based on what you know?
I think there's going to be a lot of AI and climate tech. Those are the two that I think have huge opportunities, and certainly healthcare. Because healthcare, there has so much room for improvement. So those are the three that come to mind immediately.
Great. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
I would say just what's going on right now, right? I think there's a lot of doom and gloom. People talk, a lot of media is talking about doom and gloom. And I just want to say that this isn't anything new, right? Every 10 years, we go through this cycle. There's a bubble, the bubble bursts, and then, a lot of companies go away, a lot of disruption happens. But in the disruption is when a lot of the new ideas get formed and the next generation of great companies are created. So my advice out to the entrepreneurs or to community at large is don't think the world has come to the end. I think there's more to happen. And I think the US is the best place to start a company. And this is the best time to start a company. So take a risk,
That's great. Well, so how best for listeners to get back in touch with you?
They can reach to me at my email, nitin@elevate.vc.
Great.
Oh, and one more thing I wanted to add. One more thing.
Sure.
To the investors, to the institutional investors, this is the time to invest in funds like us. So, now is the time because there's a lot of great companies at great valuations. A lot of new ideas going to pop. So don't hold back. Get back in the game again.
That's great. Well, great. We'll put the contact details in the show notes. I want to thank you for joining us today, and we hope to have you back for a follow-up again soon.
Sure. Thank you, Hal. Have a great day.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.